I am Anand here, retired Chief Manager from United India. I hope all of you have joined and the connectivity is there. Today, we are going to talk about the reinsurance. For those who have already studied this subject, this session is going to be a mere recap of what you have studied. And for those who have already attended my class earlier, you are going to recollect as to what we discussed last time, and if anything is missing, that can be again discussed here. I hope many of you would have already studied the reinsurance book of Insurance Institute of India, which is one of the papers in fellowship. Hope you must have already gone through the book already. The only difference between reinsurance and the other subjects is this. While you have the opportunity to practice other subjects like, fire, motor, engineering, etc. in your operating offices, there are two subjects which are centralized. One is reinsurance, the other one is investment. These two are centralized, so not all the employees would be having any chance to work under these two departments unless they are in head office. So this is the only difference. Otherwise, reinsurance is also an interesting subject like any other subject like fire or engineering. Reinsurance. When I say reinsurance, the first and foremost known answer as to what is reinsurance is this. Every one of us know what is reinsurance, which is insurance of insurance. There is no doubt about it. But if I were to ask you as to who wants to reinsure and why, the answer would be the insurers wants to reinsure. And why they want to reinsure? Why they can't they keep the entire premium unto themselves and the risk also to themselves? Why they want to reinsure? As all of us know, every insurance company has got limited capacity to retain a portion of the risk. When I say the capacity, I mean the financial strength of the insurance companies. The insurance companies, based on their financial strength, they retain a portion of the risk, which is known as retention, and they go in for reinsurance for the balance of the risk to be protected. But why the reinsurance is required? What is the importance of this? What are the functions of reinsurance? We need to know the basics of this, which is also the first lesson. And to understand this point, we need to know as to why we want to reinsure. There are instances of huge risks like the aircraft or the energy risk, or it can be any mega risk for that matter, which is a very big risk to be retained entirely by an insurance company. The size of the risk is so huge that it requires some protection other than the retention. So the insurance companies, what they do is, after retaining a portion of the risk, they seek the support of the reinsurers and they get the reinsurance done for the balance of the risk. To understand this point, I often used to give this example for those who have not read the reinsurance book. To understand what is reinsurance, let us take one small example which I used to give often. If you go to an electronic shop, there you find a big, a 52 inches LCD TV. You are attracted towards it and you want to buy the TV. But you realize that you don't have enough money to buy such a huge TV, though you are interested in purchasing this. You must have noticed in the same shop at the corner, there is one financier sitting there who knows that there are clients like this who are short of funds. So what he does, he calls this guy, he says, don't worry, I am here to help you out. So with the help of the financier, this client now is able to buy that TV, which was not possible earlier. In this example, we now know that what was not possible earlier became possible because of the support given by the financier. Now he is able to buy this TV and he owns it. Let us replace these two examples with the insurance company and the reinsurance. The client now is a insurance company. He wants to underwrite such mega risks like aircraft or rigs or mega policies. But he realizes that he doesn't have the retention capacity or the limit up to which he can underwrite. So he is asking the support of the reinsurers who comes to his rescue, and they are providing him the capacity as well as the terms and conditions to underwrite such huge risks. In this example, we now understand the importance of reinsurance, who provides you first the automatic capacity to underwrite such huge risks. The reinsurer lends his hand by providing additional capacity as well as the terms and conditions so that you will be able to write this business. So the first and foremost function of the reinsurance is to provide underwriting capacity, which is what I explained now. We now realized that when we have such huge risks in front of us, the insurance companies on their own cannot retain such huge risks, so they require the support of reinsurers who comes to their rescue for providing additional capacity and also the terms and conditions. And with this, he is able to now underwrite such huge risks. What we have now, the screen will not be changing now because I'm explaining the functions of reinsurance. I want to tell you, don't worry about the PowerPoint. Yeah, please listen to me, and as and when it is required, I will be changing it. Okay. Coming back to this point, I had just now explained you the first function of reinsurance, which is to provide underwriting capacity. The chain reaction to this is that if you have proper reinsurance arrangement by getting the additional capacity from the reinsurers, you don't have to worry even if there is going to be any big loss. When such huge loss is happening, the reinsurer comes to your rescue and he is paying you his share of loss. Thus, the solvency margin of the companies are not affected. The balance sheet of the company is not affected because the loss is not going to be borne fully by the insurer. He is supported by the reinsurer and the reinsurer pays his share of loss. Thus, his balance sheet is not affected, and so his solvency margin is not affected. Now I am going to change the slide. You can understand what we have discussed now. The first point which we have discussed now is about providing underwriting capacity and explained you how this is done. In this case, we have seen the first point. The second point I told you about the protection of our balance sheet as well as for the solvency margin. So this comes under the financial stability. What is this third point? Geographical spread of risk. Many of you would have heard of this terminology. There is a saying that don't keep all the eggs in a single basket. This applies to the reinsurers also. The reinsurers are supposed to underwrite the business from both the Western Hemisphere as well as on the Eastern Hemisphere also, so that the loss on the one side is offset by the profits on the other side. So there is a spread of risk. This is known as geographical spread of risk, which is one of the functions of reinsurance. The next point, as we have already discussed, is about solvency margin and other financial features. There is one more point here which we need to remember. We have spoken all along about the bigger risks and how the reinsurers comes to your rescue in giving their capacity for such big risks. There can be a situation where you are new to a particular portfolio, though the sum insured is small, since the insurance companies do not have the technical know-how as to underwrite, as well as if a claim comes, how to process. In such a scenario also, the reinsurers comes to your rescue in underwriting such policies. So the point which we have just now discussed is this. Apart from those points which we have now discussed, there can be a situation where a new type of risk has to be underwritten, like a crime policy or D&O or any new type of policy, POSI, for which the companies may not have enough required technical know-how. In such a scenario, the insurance companies seek the support of the reinsurer, who also gives his capacity as well as technical know-how as to how to underwrite and if a claim comes as to how to process. So what we have seen just now is what are all the functions of reinsurance. We have seen that it is providing you the underwriting capacity. So you are able to underwrite such huge risks beyond your attention. And if at all there is a loss, the reinsurer comes to your rescue by paying their share of loss. So you don't have to bear the entire 100% from your pocket. And hence, your balance sheet is not affected. And also the solvency margin is maintained. The next point we spoke about is geographical spread of risk, which advises that every reinsurer is writing the business on both Eastern as well as Western Hemisphere, and the losses on one side is getting offset by the profit on the other side. So insurance companies also will be having a spread of risk like this to balance their portfolio. We spoke about solvency margin and the last point about the technical know-how requirement on some of the special policies which we discussed. We now know what are the functions of reinsurance, why it is important for the insurance companies. While speaking about this, to understand the importance of reinsurance, I gave an example of aircraft, huge risks and mega policies and said that The reinsurer's support is required in underwriting such huge risks because of the limited retention capacity of the insurance company. Now, my question is this: does that mean the reinsurance is there only for such huge risks? I repeat, I am asking that, does that mean the reinsurance is there only on such huge risks? The answer is no. To understand this point, I used to give this example. Let us say that you are underwriting a PA policy of 1 crore sum insured and also a mega policy for 5,000 crore sum insured. Though it is apparent that in the second example, the companies may not be able to retain the entire sum insured, in the case of first example, which is a PA policy for 1 crore sum insured, the insurance companies have the wherewithal, the capacity, the strength, financial strength to retain the entire 100% risk unto themselves and retain the premium. At the worst scenario, the maximum loss on a PA policy in this example cannot cross 1 crore, which can be easily paid by the insurance companies. But are we allowed to retain 100% in this example? Or in the case of mega, we know we cannot retain 100%. Even though yes, risk is as small as a 1 crore policy, or in the motor policy, a TVS 50 or TVS 100 is insured, whose sum insureds are very less. And even in the case of a total loss or any burglary, we will be able to pay the any 100% of the vehicle's cost. But we are not allowed to retain the entire 100% with us because of this reason. All of you must have heard of the IRDA's regulations on general insurance, which inter alia says that every general insurance company is supposed to cede, CEDE, cede in reinsurance parlance is known as to give away. Every general insurance company in India is supposed to cede 4% of the risk as per the current financial year to the national reinsurer. Who is that? It is GIC Re. So this tells you that in all classes of business, you are supposed to cede, to give away 4% of the risk to the national reinsurer. Whether it is a motor policy, a PA policy, or a mega policy, the first job is to cede 4% of the risk to the national reinsurer. This tells you that even on a smaller risk, which we discussed now, there is a component of reinsurance, a compulsory reinsurance, which is also known as obligatory reinsurance. In this example, we found that for the current financial year, the percentage of cession to be given to the national re is 4%, which is obligatory, which is a compulsory cession. It is also known as priority cession. So these are the different nomenclatures used. What we have now seen is that whether it is a small risk or big risk, in all classes of business, you are supposed to cede 4% of the risk to the national re. So at the most, maximum, if you want to retain, you can retain only 96 and not 100. But if you now shift your point to a higher risk, to understand as to how the other reinsurance arrangements are made, we are going to take two different examples, and then we will go to the next topic, which is this one. So I will not be changing the PPT. Please follow me as to whatever I'm saying so that it will be easier for you to follow once I go to the next step. I'm going to talk to you about the reinsurance arrangements which we are going to see now. The reinsurance can be done in both these ways. It can be proportional or non-proportional. If you see this screen, the reinsurance normally is done in these two forms. The forms of treaties are, one is known as treaty, the second is known as facultative. The reinsurance arrangement can be done in two forms. One is known as treaty, the other one is known as facultative. We are going to discuss about these at length now. Before going into this, to understand this reinsurance methodology, when I use the word methodology, I mean this. Under the treaty and facultative, you are seeing proportional and non-proportional. And again, below that, what are all the proportional and non-proportional arrangements? These are known as methods of reinsurance. So we are going to talk about this, and with an example, I will give you the methods that are being followed. Now, I spoke about the obligatory reinsurance, and I said, irrespective of clause, in all the clause, whether it is motor, fire, engineering, miscellaneous, you are going to give a flat 4% of the risk to the national re. This tells you that irrespective of the clause and the size of the risk, the percentage remains same. The quota remains same. So this is an example under the quota share, which you are seeing under proportional treaty. We are going to talk about treaty later, but I just want to tell you what is a quota share treaty. It is nothing but giving away a fixed percentage of cession to the reinsurers in a class of business. It can be fire, it can be motor, it can be anything. In the case of obligatory treaty, you are giving 4% in all the classes. So this is known as quota share treaty. We spoke about this, and when I was explaining you about obligatory treaty, there are two cases where you don't have to cede 4%. One is nuclear pool, the other one is terrorism pool. These two are the exceptions. We have now spoken about obligatory treaty. Then we are going to go to the next step. To understand the next step, I am going to ask you to write down in a paper three different sides of the risk to understand this concept. Take a piece of paper in front of you and write down three different sides of the risk, which I am going to tell you. 100 crore, 500 crore, and 1000 crores. You have three different proposals. 100 crore, 500 crore, 1000 crore in a fire policy. We are going to do one small exercise here. So that is why I'm requesting you to write it down in a piece of paper horizontally. 100 crore, 500 crore, and 1000 crore. I told you for the current year, the obligatory cession is 4%. But for easy calculation, let us take 10% as obligatory cession. It is for our easy calculation, we are taking 10%, but the actual percentage is 4%. Now you have three different risks. I am asking you first step to give away dash percentage to the national reinsurer. I hope my voice is audible.
You're audible, sir.
Okay, can I go ahead?
Yes, sir.
Yeah. So I was talking to you and I'm requesting you to write down in a piece of paper as to three different risks to understand the RA concept. And I said, your first job is to give away 10% of the risk to the national reinsurer as obligatory cession, though the actual percentage is 4. For calculation purpose, I am taking 10%. If you give 10% in these three risks respectively, it will be 10 crore, 50 crore, and 100 crore. I repeat, if you take 10% obligatory on these three different risks, it will be 10 crore, 50 crore, and 100 crore. This is the first step you are doing. The next step is, after giving away the compulsory session, the next job is to give away or to retain. So first job is you are giving this to obligatory. The next step is you have to decide as to how much you want to retain. How much you want to retain. In order to decide retention, when I say retention or rating, we mean what is the maximum amount an insurance company can retain in any one risk. To decide this as to how much you want to retain in any one given risk, there are certain formalities which are being done to understand as to how it can be arrived at. Though there is no mathematical formula to arrive this, there are certain aspects which are taken into account in deciding this. One is the insurance companies go through the entire risk profile of any class of business, say for a period of 10 years or 5 years, and they look at the performance of the portfolio, and based on that, as well as based on their financial strength of the company, they decide as to how much they want to retain. Normally, when such retention decision is taken, there can be different opinions. If a finance manager of an insurance company is there, he will say that I don't want to expose more of my capital because I want to ensure minimum interest to be paid to my shareholders. This is the view from a finance manager. But if you ask the risk reinsurance executive, he will say that for whatever risk we are underwriting, we should ensure that we are protecting it adequately to take care of any huge losses. So there are different views, but in order to arrive at a common consensus, there are certain points which are taken, like the financial strength of the company, the performance of the portfolio, and how much maximum we can expose on a risk, how this can be done. Based on all these factors, the retention is being decided by the insurance company before the financial year starts. For instance, In the case of fire, the retention can be both on sum insured as well as on PML, probable maximum loss. By underwriting on PML basis, the insurance companies tend to retain more, so the draining out of the drain of a premium to the reinsurers will be less. As in the case like what we have seen in fire, if you go to marine department, again in marine you have cargo and hull, so the graded retention is happening there. The insurance companies may decide to retain less on an older vessel and more on a new vessel. In the case of liability, it is on any one accident basis. So depending upon the portfolio and the exposure involved, the retention is taken. In this example, we have seen that out of 100, 500 and 1000 crore, which you have written now, you have already ceded 10% of this risk to the national reinsurer. And we are coming to the next step, which is retention. Let us take an example that in this case, the insurance companies have decided to retain a maximum of 100 crore for any one given risk. Let us say that for the ensuing financial year, this insurance company has decided to retain a maximum of 100 crore per risk in fire department. So in these three risks, which we have written now, we are going to utilize our retention. If you come to the retention, in the case of first example, house risk, sum insured is 100 crore. Out of 100 crore, we have already given away 10%, which is 10. So balance left out is 90, whereas your retention capacity is 100. So it is well within your limit. If you go to the second case, which is 500 crore, after giving away 10% obligatory, there is a balance of 450. But since you have decided to retain 100 crore, the balance left will be 350 here. If you go to the third example, which is 1000 crore, I will be taking 100 crore as retention, and there will be a 900 crore gap will be there. In the first example, though I have 100 crore capacity, since the sum insured itself is 100 crore, and after giving away 10 crore, I require only 90. There is no problem in the case of first example. If you go to the next example, which is 500, you have seen that there is a balance left of 350 crores. And the third example, you are having 900 crores balance. Insurance companies know that the offices will be getting such proposals of this nature. So they are already into arranging for a reinsurance protection to take care of such proposals. In the second and third example, after obligatory and retention, there are surpluses left. In the case of second example of 500 crore, after 50 and 100, you are having a surplus of 350. In the second example, you are having a surplus of 900. In the case of the third example, you are having a surplus of 800. Sorry, out of 1000 crore, you have given away 10, which is 100 crore. Your retention is 100 crore. So the surplus left in the third example will be 800 crores. To take care of such surpluses over and above the obligatory and the retention, the insurance companies are entering into an agreement between the reinsurers, amongst the reinsurers, to take care of such surpluses over and above obligated retention. And this reinsurance arrangement is known as treaty. This reinsurance arrangement is known as treaty. I will repeat. I asked you to write down in a piece of paper 100, 500, and 1000 crore. We have utilized 10% to the obligatory. So after that, the retention will be a maximum of 100 only. So in the first case, there is no problem. In the second case, after the obligatory and retention of 100, you are having 350 crore surplus. In the third case, it is 1000 crore minus obligatory 100 minus your retention, it is 800 crore surpluses. So there are cases where you will get such big proposals. To take care of such big proposals over and above your retention, if there are any surpluses left like this, such surpluses are taken care of by an arrangement which is known as treaty. Treaty is a word which we all have heard, in the newspaper and TV. Treaty is nothing but a reinsurance agreement. This agreement is between the insurer on the one hand and various reinsurers on the other. The treaty reinsurance arrangement is done like this, like there is one booklet which will have the details of the treaty, like what are all the terms and conditions, what are all the exclusions, etc., and claims experience of this treaty, and this is being shared to the reinsurers for their support. The reinsurer goes through this and he is agreeing for the same and he is giving his support. So this is how the treaty is being finalized. Since these treaties are taking care of such surpluses, they are all known as surplus treaties. I have spoken about surplus treaty now and how it is arranged. We have seen from the second and third example, there are surpluses of 350 and 800 crore respectively. To take care of such surpluses, the insurance companies are entering into a reinsurance arrangement, which is known as a treaty. These treaties are taking care of surpluses, so they are all known as surplus treaties. What we have seen now is what is the next reinsurance arrangement available after the retention. So after the retention, you have a surplus treaty to take care of such surpluses. Okay, in the example, we have seen it is 1000 crore. Tomorrow you may get a very big policy, very big mega policy for 20,000 crore also. In such a situation, the surplus left will be more. Does that mean the treaty reinsurers who have given the support for the surplus treaty arrangement will be able to take any such huge surpluses also? Logically, it is not possible. As we know, like the insurance companies, the reinsurers also have limited capacity. So they will not be able to take the entire load of surplus, whatever is there, on their head. So what they do is that they look at their financial strength. They look at the retention, how much it is being kept by the insurance company, and then they are arriving at a limit by saying that, okay, boss, I'm ready to support you, but not up to the sky high limit. I will give you support only up to, let us say, 5 lines. He puts a condition that I will support you only up to 5 lines. What he means by a line. The line is nothing but the amount of retention an insurance company is keeping unto itself. So in this example, I said 5 lines. It means 5 times of your retention. What is the retention we have taken in this example? We have taken 100 crores. So when I say 5 lines, it is 5 into 100. It will be 500 crores. So what is the maximum support this surplus treaty reinsurers give on any particular risk? On any particular risk, at the maximum, they can give 5 times of your retention, which is 5 into 100, 500. We found in the second example, the surplus is only 350 against the treaty capacity we have 500. So there is no problem. It is well within the treaty's capacity. But if you go to the next example on 1000 crore, we are having 800 crore after utilizing 10% obligatory, which is 100 and retention 100. You have 800 crore. Since the treaty is supporting only up to 5 times of your retention, which is 500, there is a shortfall of 300 in this case. In this case, there is a shortfall of 300 after fully utilizing the surplus treaty capacity of 5 lines. In such a scenario, where there is a shortfall, or in a nutshell, you cannot give your own terms in the absence of any reinsurance arrangement. If you take the third example of 1000 crore, you have 100 crore for obligatory, which is 10%. You have 100 crore for your retention, which is also 10% of the risk. You have a maximum support of 5 lines from the surplus treaty, which is 50%. So the balance unreinsured portion comes to 30%, which is 300 crore. When you have such a shortfall, the companies will not be giving their terms because the 30% of the risk is unprotected. In the case of second example, which you have written 500 crore, your requirement was only 350 against surplus treaty capacity of 500. So you didn't have any problem. So whichever proposal which is within the treaty capacity limit is known as automatic capacity, which is known as automatic capacity. But the moment it crosses and a shortfall occurs, you are at the mercy of those reinsurers who are going to support for the balance portion. In the case of third example, we realized that there is a 30% shortfall, and hence we seek the support of the reinsurers to take care of this 30%. Insurance companies prepare a slip containing the details of this proposal, the rate suggested, deductible, claims experience, and go to the reinsurers asking for support to the extent of 30% for this risk. They go to reinsurer A and give their slip, and it is rejected by reinsurer A. He is not agreeing for your rate or terms and conditions. Again, the insurance company goes to reinsurer B. He goes through and again he slams the door. He is not interested in supporting. And you are going to reinsurer C and he is ready to support you, but not on your terms, but on his terms. For example, if the insurance company says it needs to be charged at 1 rupee per milli, he says no, 1.2. Deductible 50,000 given by insurance company. No, it should be 75,000. Every year, let us say in this risk, there is a flood loss. And he goes through the claims experience and he knows that every year during flood, the godown is getting affected. So he imposes a warranty saying that all the stocks are kept at least 5 foot away from the ground. This is a counter offer from the reinsurer C. This example tells you that number one, these reinsurers to whom you have sought the support for the balance portion, in this case it is 30%, they have an option to say no to your proposal. In contrast, the surplus treaty reinsurers who are supporting you up to the 5 times of your your retention, they don't have an option to say no to you because they have already agreed. This is the basic difference between the surplus treaty reinsurers and those reinsurers who have an option to say no. These type of reinsurance where you seek the support of reinsurers support on case-to-case basis only is known as facultative reinsurance. Now we are talking about facultative reinsurance. What is facultative reinsurance? It is a reinsurance where you seek the support of the reinsurer to support to the extent of limit you required. In this case, it is 30%, but they need not agree to your terms. They have the right to say no, unlike the surplus treaty reinsurers. They have an option to say no to your proposal, whereas surplus treaty reinsurers do not have an option. This type of reinsurance is known as facultative reinsurance. Obviously, from the examination point of view, they'll be asking as to which is convenient, whether surplus treaty or facultative. Logically, if you see the procedures we followed, surplus treaty is administratively easier than the facultative reinsurance. So surplus treaty arrangement is preferred than the facultative reinsurance, though there can be cases like what we have seen now. We have to go and ask for the support once you fully exhaust surplus treaty arrangements. So what we have seen now is what is facultative reinsurance, which is nothing but a reinsurer who is coming to you, who you are asking the support of the reinsurer only to the extent of the percentage you require to cover the balance of liability, and those reinsurers have an option to say no. And this is the difference between the other type of reinsurance arrangement we have seen. One is quota share, which is obligatory. Next came the surplus treaty. So now we know what are all the methods of reinsurance under the proportional treaty. In this example of 1,000 crore, we have seen the risk is shared 10% by obligatory, 10% is your retention, and 50% is by treaty supporters, and 30% by the facultative reinsurers. Let us assume that you are getting the support from the facultative reinsurers on their terms, and you are giving it to the client and you are getting the business. The term given by the facultative reinsurance will be applicable 100% on the 100% of the risk, and the premium terms and condition will be based on his offer only. So whatever he has given is fully applicable for the entire risk, entire proposal. So let us say this facultative reinsurer has charged 1 crore as premium for 100% of the risk. We have seen that this risk is shared 10% obligatory, 10% retention, 50% treaty, and 30% fact. In the same proportion, this premium will also be shared. What will happen in the event of a loss? In the event of a loss also, the losses will also be shared in the same proportion. So what we have seen is when a risk is shared in some percentage, the same way the premium is also shared as well as the losses. Such type of reinsurances are known as proportional reinsurance. The examples under proportional reinsurances are quota share treaty we have seen. We have seen surplus treaty. We have seen now the facultative reinsurance also. In this case of quota share, we studied that a fixed percentage of the risk is being ceded to the reinsurers on a class of business. So it is not for only one or risk or two risks, it is for the entire class. This is known as quota share. But there can be an arrangement where the retention can be more and the ceding can be less, vice versa. That is known as variable quota share. That is known as variable quota share. The one which we are seeing is fixed quota share or quota share in general. So we have seen what is proportional reinsurance under treaty, and we now know what are all the examples. Having spoken about these, we now know that when a risk is underwritten, the risk can be underwritten provided you have support like the surplus treaty. Companies can have a first surplus treaty and second surplus treaty like that, and beyond that, the facultative support for any risk only if it is required. So this is about the proportional reinsurance which we have discussed. I am going to talk about the other method of reinsurance, and later I am going to talk about the accounting aspects as well as the clauses. Before going into that, we will see what is non-proportional reinsurance. The methods are proportional and non-proportional, and we have seen proportional reinsurance. Now we are going to see what is non-proportional. It's a mere recap now. What is a proportional reinsurance? Under proportional reinsurance, the sum insured premium and losses, if any, irrespective of the size of the loss, are shared proportionately. See, when I say loss, it includes the claim related cost also. Even a surveyor fees or legal fees, these can also be shared in the same proportion the way you have shared the risk. What are all the examples under proportional reinsurance? So from the examination point of view, they may give like this: quota share, surplus treaty, facultative, pools. So these are all the examples which are coming under proportional treaty, which we have seen. What is a quota share treaty? Where the ceding company cedes a fixed proportion of all business in a class to the reinsurer. So there is no selection involved. It is supposed to be given for the entire class of the business to the reinsurer. I gave you an example. Now let us see this also. In this example, the insurer retains 10% and he is reinsures 90% flat in this class of business in fire, let us say. So whether it is 5 lakh sum insured or 50 lakhs or 1.5, whatever be the size of the risk, even if the size of the risk goes up, the percentage remains same. So he is ceding 90% to the reinsurer in the entire class. Variable quota. In the case of quota share, it is a fixed percentage. But if you have the variation, like what I have told you earlier, it's a method in which the percentage of retained sum insured varies for different limit of sum insured and reduces with increase in limit of sum insured. So there is no fixed retention here, like what we have seen earlier. It can vary depending upon the risk. So only after retaining a variable retention, it can be 10 crore, it can be 8 crore, but maximum will be 10 crore. So the balance is being ceded to the quota share reinsurer. This is known as variable quota share. There is one arrangement with a combined combination of quota share as well as surplus treaty. And we should also know about the line here. Line we spoke about, we said what is a line is nothing but the amount of liability which an insurance company has decided to retain unto itself. The example which I gave you was 100 crore in that example. So there can be an arrangement on net line as well as gross line. Let us say this example, there is a quota share treaty of 100,000 instead of percentage. It's a limit here given. And in this case, the maximum retention is 10,000. This 10,000, which is retained in a quota share, is known as net retention. But when I arrange a surplus treaty on net retention, it is 9 into 10,000, 90,000. But I can arrange a surplus treaty on gross line basis also. So gross line is nothing but the quota share treaty limit. Whatever is the treaty limit is there, that is the gross line. So if you see here, it can be done both on net lines as well as on gross line. What is a gross line? Gross line is nothing but the limit of the quota share in which already you have the net line. In the example given above, you can see that in the quota share treaty limit of 100,000, ceding insurer retains a maximum of 10,000. So there is a net line is there. You can arrange a surplus treaty of 9 times of your written net line, or it can be on the size of the quota share treaty itself, which is 100,000 into 9. That is known as gross line. So what we have seen is a net line and a gross line. Now we are slowly going into the next aspect. Under proportional treaty, the reinsurer's liability commences simultaneously with that of the ceding insurer. So when I spoke about proportional treaty, the surplus treaty's inception and the ending date is from 1/4 to 31/3. And normally these are done on a risk attaching basis. This is known as risk attaching basis. That means the reinsurer covers only the policies issued or renewed on or after the inception date of the treaty as agreed with the reinsurer, So only those policies, in a simpler way, we can understand that the treaty period is from 1/4 to 31/3. The treaty reinsurers are ready to accept all those policies which are incepting between 1/4 to 31/3. This type of arrangement is known as a risk attaching basis. Now, we spoke about surplus treaty. So I have given the definition here. It is a surplus treaty where the ceding company reinsures only those amounts a surplus of its own retention. So only after exhausting your retention, you are going to utilize this capacity, which is known as surplus treaty. How the surplus treaties are arranged? A surplus treaty is usually arranged in terms of number of lines. What is a line? We all know that the amount of retention of the direct insurer is the line. And just now we learned that a line can be a net line or gross line. Net line is the amount of retention of the direct insurer. Gross line is the full capacity of the quota share on a combined quota share surplus treaty arrangement. The ceding insurer decides what part of the original insurance he wishes to retain for his own account and reinsures the balance. So an example is a ceding insurance maximum retention may be 20 lakhs on fire. Then the cession to surplus treaty shall be. So I am taking one example here with the three different size of sum insured. So one is 20 lakhs. I have decided to retain maximum of 20 lakhs already. So there is nothing goes to surplus because there is no surplus left. 30 lakhs, after utilizing 20, I am giving away 10. And in 50 lakhs, after giving away 20, I am giving the balance. After keeping 20, I am giving away or ceding to 30 lakhs to the surplus treaty. So I said this surplus treaty can be arranged on a sum insured basis, also on probable maximum loss basis. It can be done on sum insured as well as on PML, probable maximum loss basis. The advantage in ceding or in underwriting PML basis is this. When you do it on PML basis, the insurance companies retain more, and only after retaining, if there is any surplus, that will be ceded to the surplus treaties. So the amount of cession on PML will be lesser when compared to sum insured. Also, the retention percentage will be more, and hence you will retain more premium if it is underwritten on probable maximum loss. The next point which we are seeing here is ceding commission, which we will talk about this later. I have given one more example here as to how an RA arrangement is being made by taking 4% in this 500 crore proposal, and after giving away 4% of obligatory, in this case, this insurance company is retaining only 50 crores, and then they have first surplus treaty arrangement and second surplus treaty arrangement, and then it goes to facultative. The balance is 26%, which is taken care of by the facultative reinsurance support. This is one more example of how an underwriting on PML is done. So I'm just skipping this for now. This I will discuss later. First, we will go to what is a fact, which we discussed, the system by which each offer of reinsurance is considered individually by the reinsurer and either accepted or declined. And we all have spoken about pool. We all know about pool. So what is a pool? It is also a form of reinsurance arrangement between member companies by which one or more classes of business is pooled and then retroceded to members in an agreed proportion of volume of business ceded. See, what is terrorism pool? It is also an arrangement where the member companies, all the insurance companies, have pooled in their resources, and from there again it is retroceded back to the companies. So the example is our terrorism pool. We are going to now talk about the other method of reinsurance, which is known as non-proportional reinsurance. Let us not go by this PPT for now, just wait. Like what I have asked you for understanding the proportional reinsurance, I'm going to give you an example to understand non-proportional reinsurance. Please recollect, in the case of proportional reinsurance, you decided to retain 100 crore in each of these risks which we have written. That 100 crore is known as a risk retention because you are sharing a portion of the risk unto yourself for retention. So that is known as risk retention. In contrast, now we are going to talk about a non-proportional reinsurance by taking one example. Let us say that there is a big fire in one of the factories. Neither side of the compound are affected, only one risk is affected, and there was a huge fire. Let us say that in that huge fire, the insurance company's net loss is 300 crore. I am talking about one example of a huge fire in a chemical factory, let us say, where the company's net loss is 300 crore. I am not talking about the gross loss. I am talking only about the net loss. Why I am worried about net loss? Because other than net loss, all the other aspects of reinsurance recoveries are there. So I am worried only about the net loss. In the gross loss, you are having the opportunity of recovering from the obligatory, surplus treaty, and fact. The only area where no recovery is possible is from your retained loss. So I am worried about this net loss. The net loss in this example is 300 crores. There are n number of such huge risks which are being underwritten by the insurance companies. So the insurance companies purchase a protection to take care of such a huge net loss, where they say that, for example, if at all such a huge risk loss happens, I am ready to bear first 25 crore of loss, and you pay me the balance in excess of this up to the limit of the cover which I have purchased. Let us say that this insurance company has purchased a cover for 300 crore excess 15 crore. This insurance company has purchased a cover for 300 crore excess 15 crore to take care of such risk losses. Here we have seen that there is a net loss of 300 crore. When there is a loss of 300 crore to the net, since they have already purchased this risk excess of loss cover for 300 excess 15 in this case, they have to bear the first 15 crore loss from their pocket, and the balance of 285 crore will have to be recovered from the reinsurers, since the cover limit available is 300 crore. In this case, we have seen that even though the net loss is 300 crore for the net, this is protected by a reinsurance arrangement in excess of a loss amount of 15 crore, and that arrangement is known as excess of loss. And since it is taking care of individual risks, they are all known as risk excess of loss. In this example, though the net loss is 300, since they have purchased a protection for 300 crore in excess of 15, the insurers will get 285 crores from the reinsurers. What will happen if the net loss is 400 crore? If the net loss is 400 crore, after bearing first 15 crore, you will have 385. But since you have purchased the cover only for 300, the reinsurers will pay only 300 crore and the 85 crore will again fall back on the reinsurers. This type of reinsurance is known as excess of loss reinsurance. Please note in this example, I have not spoken about the size of the risk at all. I have spoken only about the quantum of loss. In this case, the quantum of loss or the quantum of net loss is 300 crore and they are able to recover 285 crore. So there is no proportionality involved. The loss can happen in any size of the risk at various dates as per the loss. The net loss of 300 is protected, where the reinsurer is paying you after 15 crore to be borne by the insurers. So the balance 285 is recovered. And we have seen that in one more case, if the net loss goes to 400, after bearing the 15, you will have 385. But since you have purchased the cover only for 300, you will not be able to recover the balance 85. It will fall back on the insurer. So this type of reinsurance is known as excess of loss reinsurance, and hence, since it is taking care of individual risk, it is risk excess of loss. The same methodology is followed for the catastrophe excess of loss also. The only difference is that in this case, we spoke about the individual loss, whereas in the case of catastrophe losses, it is not about one or two risks. There are n number of risks which are affected by the AOG perils, and we call it an event loss. So the catastrophe loss is taking care of such event losses in excess of a predetermined loss amount to be borne by the insurer up to the cover limit purchased. So it is similar to the cover limit and the recoveries are similar to risk excel. Only thing is, in the case of cat excel, it is taking care of event losses, whereas in the case of risk loss, it is taking care of individual risk. We have seen how the risk excess of loss is there, covers, protects, and how the cat excess of loss protects. Apart from this, there is also an excess of loss arrangement, which is done as based on the loss ratio, which is known as stop loss arrangement. In the case of stop loss arrangement, instead of the quantum which we have seen, it will be the loss ratio based on which the protection is available. For example, in the case of stop loss, the reinsurers may say that the cover will be like this. It will be 150% in excess of 90%. That means any loss ratio up to 90% will have to be borne by the insurer. And once the loss ratio crosses 90%, but up to 150%, that will be protected by the reinsurers. In case if it is 160%, again, like what we have seen in the risk excel or cat excel, the unprotected left out loss ratio will have to be borne by the insurer. So I repeat, we have now spoken about the stop loss reinsurance arrangement, which is instead of the loss amount, it takes care of the loss ratio. And once the loss ratio crosses the threshold limit up to the agreed percentage, the reinsurer comes to your rescue and pays the losses. This is known as stop loss arrangement. Apart from this, we have umbrella excess of loss as well as whole account excel also. These are all the types of excess of loss arrangements we have. When I spoke about stop loss reinsurance arrangement, I said that if a loss exceeds 90%, and if it is up to 150, it will be protected by the reinsurers. And once it exceeds 150 and whatever balance is there, it will come back to the insurance company. There can be a single composite cover also, which is known as whole account excess of loss. This method is common in miscellaneous and other departments also, which covers the entire book of business. And umbrella excess of loss is there, which is taking care of any gap in various reinsurance arrangement. So these are all the types of excess of loss arrangements which are coming under non-proportional treaties. Now we will see whatever we have discussed under the non-proportional reinsurance arrangement. One is excess of loss, the other one is stop loss. The stop and drop cover is a cover which comes down. As the name indicates, the cover will drop down to the layer limit wherever it is fully exhausted. Thus, you will have a protection for the particular layer. So this is known as top and drop cover. So these are all the examples under the non-proportional reinsurance. We have seen what is the per risk cover. We have seen what is per event cover. Now we are going to the next important step. We have spoken about the cover limit in the excess of loss cover. The excess of loss cover normally is in a quantum like 300 excess 15, 200 excess 15 like that. But when you purchase a cover for 400 or 300, the limit is very huge. So not all the reinsurers would like to participate in such a huge sum insured. To enable the reinsurers to participate easily, the cover limit is split into various layers. I repeat, what we are now discussing is about the cover limit and how it is being sliced into various layers. In this example, we can see how the layers are being done. The entire cover limit is split into three in this example. And you can see the first layer is taking care of 50 crores in excess of 15. That means this layer 1 reinsurance limit is 50 crore in excess of 15. And the next one is 40 crore in excess of 65. So the next layer comes for the balance portion. You can see from this example that each and every layer has a limited sum insured, limited loss limit, which enables the reinsurer to select and participate as per his financial strength And this is the reason for layering the cover limit. So the cover limit is split into various layers like this. If you see here, for layer 1, the deductible is 15 crore. This is also known as priority. The 15 crore is also known as priority. We have heard of this priority session in the proportional treaty under obligatory. So the same priority word is used here for this deductible also. If you go to layer 2, the 40 crore limit can be utilized from layer 2 only after exhausting 65 crores from the layer 1, which is nothing but 50 plus 15. So for layer 2, the deductible is 65. So only after exhausting 65, you will come to 40. So this is how the layering is done. Now we know what is a layer. Layer is nothing but division of the cover limit into various limits to enable the reinsurers to participate based on their financial strength. Some may participate in layer 2, some may participate in layer 3, some may participate across the board. Nowadays, all the reinsurers are participating across the board. So this is how the layering is done. Hello. பாலாஜி சார் இது இப்போ பிரேக் விடணுமா பிரேக் விடணும் அப்படியா ஓகே ஓகே நீங்க அனௌன்ஸ் பண்ணிடுறீங்களா இல்லை நான் சொல்லணுமா ஓகே 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 தேங்க்யூ So we have now seen what is proportional and what is non-proportional, what are all the methods there, and what are all the examples and proportional and non-proportional, how it is being done. And we now know what is a layer and what is a line and what is the automatic capacity, how the proportional and non-proportional reinsurance are made. So now we are going into the next aspect, which is how the accounting is done and what are all the clauses involved and other aspects. Before going into that, we will break for tea. Now it's 11:28. I would request you to come back by 11:45 so that we can complete the balance portion also. Thank you. Welcome back. Before the tea break, we spoke about the basics of reinsurance, why RA is required, what are the forms of reinsurance, what are the methods of reinsurance. And we have also learned what is proportional reinsurance, non-proportional, what is line and what are layers. Now we are going into the next step with regard to these proportional and non-proportional reinsurance arrangements. I said when we were talking about the proportional reinsurance, the surplus treaty's inception as well as the expiry date will be from 1/4 to 31/3 normally. That means all the policies which are incepting between these two dates, even though the expiry dates will be beyond 31st March, these policies losses will be protected by these reinsurers who are under risk attaching basis. As the name indicates, when I say a risk attaching basis, whatever risks that are attaching between 1st April to 31st March will be covered under this type of reinsurance arrangement. So a surplus treaty is always on the risk attaching basis. That means it protects all the policies which are incepting or getting renewed during these dates between 1/4 to 31/3. But there are certain reinsurers who wants to wash off their liability on 31/3 and say goodbye to us, leaving the unexpired portion of the policies for which a claim may come or may not come, we do not know, without giving any protection. When they say goodbye on 31st March to wash off their liabilities, there are cases where certain policies whose unexpired portions are there. That means after 31st March, many policies will expire on 7th July, 8th July, or 10th October, like that. So you have many policies whose unexpired portion of the period is there, for which if a claim comes, who will pay? The another scenario is about the loss outstanding as on 31/3/2027 or 26, as the case may be. As on 31st March, for whatever outstanding is there, the claim will be paid later after 31st March, obviously. If he washes off his hands, who will pay for those claims? So the only way out is to calculate the unexpired portion of the policy's proportionate premium, deduct it from the outgoing reinsurers, and pay it to the next set of reinsurers to take care of the responsibility. But it's a cumbersome process because lakhs and lakhs of policies are there. If you start calculating like that, it will take time. So there are 1/24th method and 1/12 method, like that. Many methods are there to find out what are all the unexpired portion of the premium for those policies. The universal practice to arrest this problem is this. What they do when the reinsurers are going out on 31st March, the insurers are saying, okay, you can go, but you pay me 35% of the premium which I paid you over this year to take care of the unexpired portion of the policies. Similarly, whatever claims outstanding for the surplus treaties share is there as on 31st March, you please pay me 90% of the same and you please go. This means that those reinsurers who wants to go out on 31st March without protecting the unexpired portion of the policy and for those outstanding for which a claim may be there, paid there in the later year, part of the year, next year, the insurer says you are at liberty to go, but please pay me 35% of the premium which I paid you over this year by 4 quarters, and also 90% of the claims outstanding for treaty share, and you can go out. This is known as portfolio withdrawal. When 35% of the premium paid to them during these 4 quarters are debited along with the 90% of the outstanding for the treaty share, this is known as portfolio withdrawal. So in the 4th quarter, when the settlement is being done, these two are deducted from the outgoing reinsurers, and this will be credited to the next set of reinsurers who are going to participate from the 1st of April next year, so that if any loss is paid or if any loss is going to come from the unexpired portion, they should be able to pay. That credit which is given to the incoming reinsurers in the next ensuing financial year is known as portfolio entry. This type of arrangement is known as clean cut method. What we have seen now is under proportional treaty, there is a risk attaching basis which normally should cover all the policies which are incepting between the 1st April to 31st March for any loss that may eventually happen later also, but under the same risk attaching basis on a clean cut basis, the reinsurers would like to wash off their hands on 31st March. So when they go out, in order to protect the unprotected premium and unprotected outstanding, 35% of the premium and 90% of the claims outstanding are withdrawn from the existing reinsurer during the 4th quarter, which is called as portfolio withdrawal. And then the same is credited to the next set of reinsurers in their 1st quarter, which is known as portfolio entry. That means in any given year, in the 1st quarter, there will be a credit of 35% of the last year's premium and 90% of the claims outstanding to the incumbent reinsurer in the 1st quarter. And when he goes out, there will be an outgo of 35% of the premium he earned during this year and 90% of the claims outstanding at the end of this year, which will be withdrawn, and then again it will be credited to the next set of reinsurers. So in any given year, the reinsurers will have the portfolio entry, which is an income to them by way of 35% and 90%. And during 4th quarter, it is an outgo for the reinsurers, which is again by 35% and 90% respectively. What we have seen now is the clean cut method. The surplus treaties are also taking care on underwriting year basis, like risk attaching basis we have seen. And when underwriting year basis is done, it is normally done for the long tail nature policies like our engineering project policies. So if a policy, engineering policy is issued in 26, 27, whose project is going to end in 31, there may be some installment premium which are collected in 28 and 29. Those installment premium should also be credited to the incepted year's surplus treaty reinsurer, that is 26, 27 only. So also the claim recovery. This is as far as the periodicity is concerned. Now, we are going to talk about the next aspect, which is accounting. As regards the proportional reinsurance surplus treaties, கேக்குறதா சார்? அது இல்ல அது இப்ப முடிச்சிட்டு தான் பார்க்கிறேன். அதான். Okay, I will answer that. Yeah. You might have noticed that I have not changed the slide because I'm talking about 2-3 aspects which will be fully connected together, will be shown later. Okay, so please bear with me as far as the presentation slides are concerned. We are just waiting for all these points to be concluded, and I will go to the next step. I spoke about the periodicity, and I said about a risk attaching basis, and I spoke about clean cut method as well as the underwriting year method. And I said this risk attaching basis is in the surplus treaty, which is in the proportional reinsurance. In contrast, if you go to the non-proportional reinsurance, it is not on risk attaching basis. It is on losses happening. It is based on the losses that is happening during the period. The difference is that in the case of proportional reinsurance, the policies should have incepted during the period. In the case of non-proportional, the losses should have happened between 1/4 to 31/3, even though the policy might have incepted prior to that. See, this is the important factor. What we have seen is a risk attaching basis in proportional. In the non-proportional, it is in contrast to that, it is on losses occurring basis. That means periodicity is same from 1/4 to 31/3 only, but losses should have happened between these 2 dates. To understand this, I am giving you an example. Let us say that there is a policy issued on 17th March 2026, and there is a loss on 26th March as well as on 7th July. Though the policy incepted on 17th March, on 7th July 2026, there is a loss. This loss is happening between 1/4/2026 to 31/3/26. Since the loss is happening in between these 2 dates, this reinsurers will respond. Policy has incepted prior to 1/4. Loss has happened between 1/4 to 31/3. 7th July loss will be responded by the 26-27 excess of loss reinsurers, even though policy incepted on 17th March prior to 1/4. The another loss which I told you is 26th March, which happened before 1/4. Obviously, these reinsurers who are in 26-27 will not pay. Logically, this will be paid by those excess of loss reinsurers who covered the 25-26 year. So what we have seen now is a very important difference in proportional and non-proportional on how the risks are attached, how the losses are attached. Risk attaching basis, clean cut we have seen, underwriting year basis. Against a risk attaching basis, it is not risk we are talking about. It should be losses occurring during basis. The losses should have happened between these 2 dates. So this is coming under non-proportional excess of loss treaty. Now, I have spoken about stop loss. So the same I have said here, loss ratio of the ceding company is stopped at an agreed percentage. And if in any one calendar accounting year the loss ratio exceeds that percentage, then reinsurers pay the difference. So we know what is stop loss, and now top and drop. The cover protects dual protection in the form of a top and layer and also as an additional reinstatement to any of the lower layers. Now, before coming to this Excel working, I will just speak about the accounting aspect. So let us not follow the PowerPoint for now. Just forget about the PowerPoint now. I am going to talk about accounting now in the case of proportional reinsurance. We will talk about how the surplus treaty is being arranged and what is the method followed there. In the case of surplus treaty, there is one clause which is known as accounting clause. There is one clause known as accounting clause which says on what periodicity the accounting has to be rendered. In the surplus treaty, there are many clauses. One among them is the accounting clause, which says that on what periodicity the accounts are to be rendered. So, for example, in this case, let us say in fire first surplus treaty, the insurance company says that we will render the account every quarter. That means the accounts will be given for every quarter. For April, May, June, I will give you one account, and June, July, August, September, another account. It is like that. Now, what is happening is when I render the account for the first quarter, I have to give this account within some days. I have to commit that. So I say that this accounting will be done and given to you, let us say within 90 days from the end of the quarter. That means for the period April, May, June, I will give you the accounting within 90 days from the end of 30th June. After that, within 1 month from this receipt of our accounting, the confirmation has to be provided by the reinsurer. Within 1 month from the confirmation, the settlement on either side will happen. So all these deadlines, periodicity deadlines, are given in the accounting clause. So it says that every quarter I will be rendering you, the accounting will be given within 90 days time, and then after that, within 1 month time, you have to confirm, and within 1 month from the date of receipt of the same, I will make a settlement, or the settlement will be done by either side depending upon the balance. This is how the accounting clause works. Let us now go to one example as to how a surplus treaty accounting is done. A surplus treaty accounting is done in this way. I will show you one by one. You just follow the points so that you'll be able to understand. We spoke about the premium to be paid to the surplus treaty reinsurers. So for any given quarter, on whatever surplus we have utilized, we are supposed to give away that premium also to the reinsurers, isn't it? Because we have utilized the capacity. So from April to June, wherever such surplus treaty arrangements are utilized, the relative premium for the quarter has to be paid to the reinsurers. It is an income to them. Same way, if there is any claim is recoverable during that period, that claim is also recoverable, which is an outgo for the reinsurers. There is one more component here, which you are seeing in the screen. Wherever reinsurance premium was ceded, the reinsurers are giving away a commission, which is known as reinsurance commission, to somehow offset your direct side expenses on getting this premium. Though the commission may not fully offset your expenses, they are giving this as a token of an incentive so that you will be getting some percentage to take care of that. This is RA commission. The RA commission is receivable by the insurer on the premium ceded to the reinsurer. If you see the first example, it says 5% on the premium or 10% on the premium. It is a flat percentage. If, for example, during the quarter, I am paying 100 crore rupees as premium to the reinsurer, which is an income to them. As per this agreement, I am supposed to get 5 or 10%. Only one will be there. So let us take 10% of the premium will be given back to the insurer as an RA commission. So I will be getting 10%, 10% of 100 crore as an RA commission from them, which is an outgo for the reinsurers. In the quarterly statement, you will have 100 crore as a premium income to them and 10 crore as an outgo for them. And then if there is a loss, say 50 crore recoverable from them, it is an outgo for them. So that will sit on the outgo. 100 crore is income, 10 crore is an outgo, 50 crore is an outgo. So this is how the statement is done, and every quarter it is being rendered to the reinsurers. In contrast to the flat rate commission, the reinsurers are giving this one, the commission now is not on flat basis. It is linked to the loss ratio of the treaty. That means they are linking it to the performance of the treaty so that if there is an improvement or loss ratio is less, you will get more commission. If the loss ratio is more, the commission is less. As can be seen from this scale, this is known as sliding scale commission. As the loss ratio goes up, the commission is coming down. As the loss ratio is less, commission is more. But when will we know the loss ratio? The loss ratio, obviously, you will know only at the end of the year, no? After the accounts are closed. So till such time, when you are entering the quarterly account, you can deduct a commission, which is known as provisional commission. What we have now seen is a commission given on the reinsurance premium. It is not only on the surplus treaty, reinsurance premium commission is given on any RA premium ceded. It can be obligatory, it can be quota share, it can even be facultative reinsurance. There is an exception in the case of facultative reinsurance, where sometimes the reinsurers might quote the rate as net to the insurer, net to the reinsurer. That means whatever rate I have given you, it is net to me. If you want to add RA commission or any other loading, you may load it and finally you give it to the client. But to me, this is the rate. So these are the commissions which we have seen, which are being done now, flat rate of commission and the sliding scale of commission. We have also seen what is portfolio entry and portfolio withdrawal. So we now know what are all the basic calculations that are being made in any surplus treaty on quarterly basis. If I want to know how the surplus treaty has performed, I have to see the entire performance of the entire year's performance by adding up all the quarterly accounts data, and then I find out whether the surplus treaty has run into profit or a loss. Supposing after adding up all the income and all the outgo for a surplus treaty in a given year, if there is any profit left to the reinsurer, I repeat, I am now talking about the performance of the surplus treaty. The surplus treaty performance can be found out by finding out what is the total income and what is the total outgo for any given year. If after getting the income and outgo, the income is more, that means the surplus treaty is profit. When the income is more, that means the surplus treaty is profitable. If the outgo is more, that means there is a loss to the reinsurers. So I'm trying to find out how a performance of the treaty is by looking at it to what is its total income and what is its total outgo. Let us see by this example. I have given you an example as to how this treaty has performed. You please see in the first left-hand side, no, I have given premium during the year it should be. Kindly correct it, I will correct it later. It is not during first quarter, let us say it is during the year. The premium during the year means how much I have ceded to the treaty. What I'm talking is now about the whole performance. So it is not quarterly account. I repeat, I am talking about the performance of the treaty. The performance of the treaty is arrived at by calculating like this. It is not a quarterly account, kindly correct it. It is for the year. Premium during the year. Premium during the year is this much, which is 23 lakh rupees. This first quarter premium is how it is arrived at by adding up the premium ceded in all the 4 quarters. We now know what is premium portfolio entry. What is portfolio entry? It is nothing but the 35% of the last year surplus treaties premium which we debited from the last year's reinsurers, which is credited to the first quarter of this reinsurers. It is an entry, means it is an income for them. So also the loss entry, which is nothing but 90% of the last year's outstanding debited from the previous set of reinsurers, which we gave as an entry profit to the current set of reinsurers. The next next point is about the outgo. If you see the outgo, the commission is an outgo for him. He is paying out from his pocket. He is paying claims also from his pocket. And then there is there, if you have deducted the outstanding and premium, that will also be there. In this case, it is not there. So he has no other outgo. If you see the income and outgo here, he has got a profit. The total income is 35 lakhs. Outgo is 11 lakhs 75,000. So income is more and there is a profit. So this profit is being shared by the reinsurers. In this example, Swiss Re is participating to the extent of 10%. So his share of profit is 2,32,500. So this reinsurer ended up in profit of 2,32,500 arising out of the surplus TT. He is happy. He will support you next year also. You see, when such things happen, when a profit is there to the surplus treaty, please note, when there is a profit to the surplus treaty, the insurers say that the profit is because of our prudent underwriting. And so we are also entitled for a portion of that profit. Whatever you have earned out of that profit, we are entitled for a portion of it. That is known as profit commission. What we have now learned is profit commission. It is nothing but a commission earned on the profit of the surplus treaty. So when I ask for such profit, in this case, let us say the profit is 23,25,000, then I will say you give me 10% of this because of my prudent underwriting only. You have got this profit. Now we are going to see how this profit commission is worked out. The profit commission, whatever you are asking, let us say that you are asking for 10% of the profit. Then the reinsurers say, you please look into the condition which we have agreed during the surplus treaty finalization. If you see there, I have given one condition that this profit has to be adjusted on an average basis for 3 years, and still if you have profit, you claim that. So this is known as profit commission on 3 years average basis. You see in this example, there is a portfolio entry, there is a loss entry, so total amount is there. This is the income for him. After that, there is a commission, then there is a claims paid, then management expenses of 2.5, and at the year end, there is a premium withdrawal and loss withdrawal. Add up all these things, it comes to 26 lakhs. So 35 lakhs minus 26 for the year profit is 8,13,000. There is a profit of 8,13,000. The insurance company goes and asks him, you please pay me 20% of that profit, because of me only you earned this profit. The reinsurer says that you please look into the agreement, what I have said. If at all there is a profit, it has to be adjusted on 3 years average basis, and still if you left out any profit, then you can claim that. So now we have to go back to 3 years, means current year 23-24, there is a profit. In 22-23, there was a loss to the extent of 1 lakh, and profit in 21-22, which is 1,25,000. So after doing this, I have to find out the average profit, and then that means divided by 3. So if you add 23-24 minus 22-23 plus 21-22 divided by 3, you will get the average profit, and you are entitled for 20% on the average profit commission. So this profit commission is on 3 years average. Now we know what is profit commission. The next one is known as LCF. That means instead of average, in this case, they say that you get the net profit by taking 3 years. See here in this example, I have taken the same figure here. Only thing, instead of dividing by 3 for average, it is a net. So 813 is the profit. I have to deduct 1 lakh, and then I have to take profit of 1,25,000. So the net will be for the 3 together, it will be 8,38,000. And then on that 20% is claimed by the insurance companies. This is known as losses carried forward. This is known as losses carried forward. So this is under profit commission. So what we have seen is what are all the different types of commissions and how it is being worked out. And we found that this insurance company is asking for profit commission also, whereas the profit commission can be done both on 3 years average basis as well as on 3 years adjustment basis also. So theoretically, there is one super profit commission also that will let us not go deeper into that. So what we have learned is that in the surplus treaty, the insurance companies are getting for sure a premium commission, which is known as reinsurance commission. This is also known as ceding commission. It can be fixed percentage or it can be on sliding scale commission. But profit commission, you are eligible only if there is a profit, only after if there is an average condition, if it is ending up in profit only you are eligible, or if it is based on adjustment, still if you get net is profit, then only you are eligible for it. So we have seen in surplus treaty how this accounting is being done. When I spoke about the accounting period, I said it is done on quarterly basis. Long back, it was done on half-yearly basis. What does it mean? For April, May, June, you are rendering an account to the reinsurer, and you have to wait for his nod, his agreement. And then if any amount is payable on either side, it is being done. What I mean by either side, if it is a negative figure, then it means that the reinsurer has to pay you for that quarter. Correct? No? The same way, if it is a surplus plus figure, then you have to pay to the reinsurer. So this is how it happens every quarter. But you cannot wait for the recovery of surplus treaty share till the quarter ends and then accounting period ends. There are cases where huge losses are paid immediately. And so in such cases, you also want to recover that losses immediately from the surplus treaty reinsurers without waiting for the quarter to end and accounting to be confirmed and settlement is done at a later stage. It takes a long time. So there is an arrangement which is known as cash call arrangement, which means whenever there is any loss happens beyond a stipulated amount mentioned in the treaty, the insurers are supposed to inform the surplus treaty reinsurers about that and keep them informed about the developments also. And subsequently, if a loss is paid, the loss is also recoverable immediately under cash call position, where you can raise it without waiting for the accounting to be over, without waiting for the quarterly accounting to be over. That means if there is a loss in the month of May, and if you happen to settle the same at the first week of June, you don't have to wait for the surplus treaties of recovery till the account is rendered and his confirmation is received, which will take more than 3 or 4 months. Instead, if you have this cash call facility, you can immediately raise the same and the amount is recovered immediately provided you have this facility. This is known as cash call facility. So this is how the surplus treaty accounts are being rendered. What we have seen is how a premium is paid quarterly, what is the premium portfolio entry and portfolio withdrawal, and what are all the expenses and outgo. And still after that, if there is any surplus, the reinsurers are ready to pay surplus treaty, provides the profit commission, provided if it is there in the agreement. And if it is there in the agreement, on what basis the same has to be recovered, whether it is on average basis or on 3 years extension basis, we need to find out. So in a nutshell, we have now seen how the accounting is done in the surplus treaty and what are all the clauses involved. In the same agreement, you will have the exclusions also, like, terrorism is excluded. So the exclusion clause will talk about what are all the exclusions, and then the clauses will also be there. So these are to be, fully understood. And then these are already mentioned in the treaty slip. So we have spoken about the commission as well as about the accounting aspects of proportional reinsurance, that is surplus treaty. One thing we should bear in mind is unless the surplus treaty or obligatory treaty, which are of whose accounts are rendered in a periodicity like quarterly or half-yearly basis, the facultative reinsurance is something unique since it is arranged on a case-to-case basis. The premium has to be paid as per the premium payment warranty. The reinsurers will not wait for a quarterly account or nothing like that. So they say that when there is a facultative reinsurance is finalized, in the same slip they give the premium payment warranty. That means within what date the premium for the reinsurers are to be rendered. And not only that, what are all the formalities to be followed if there is a claim. For example, in the case of surplus treaty or any reinsurance arrangement, if you have a claims cooperation clause, the reinsurer expects the reinsurer to keep them informed of the any likelihood of loss that is reported to the insurers once the loss limit exceeds the predetermined amount given in the agreement. For example, they may say, please inform us if there is a loss intimation once it crosses 75% of your retention limit. So that is the limit they have given. If it is crossing that point, that means you have to keep the reinsurers informed about the loss and the subsequent developments. There is one more stringent clause which is known as claims control clause, which is more stringent than this, where the reinsurer takes the entire control of the claim and adjusts the claim also. So that is coming under claims control clause. What we have seen is claims cooperation clause and then claims control clause. We all have heard of the before that, I will talk about the next clause, which is known as set-off clause. Set-off clause enables the insurer or the reinsurer to offset the difference and pay. So in this case, if there is a set-off clause in the agreement, then this facilitates the insurer to adjust any premium receivable or any claim receivable from the same reinsurer in another class and pay the difference only to them. So this will help in adjusting or offsetting the receivables also on either side. So this clause in reinsurance agreements permits each party to net amounts due against those payable before making payments. So this settlement method is especially important in the event of insolvency of one party. It can happen or it cannot happen, need not be included. But the very idea is that if you have this set of as it permits each party, it can be an insurer or reinsurer, to net the amounts due against those payable. So this is done only if you have set of clause. We spoke about accounting clause, then there is one more clause which is known as currency clause. Some insurance companies have their branches in overseas also. So for those also, under one roof, they may take a surplus treaty protection under various taking care of those various branches. Now, what's happening is, if you have this currency clause in advance, this clause may stipulate, for example, like this, for all those branches which are underwriting in different currencies, the accounting will be in the respective currencies. But when a settlement is made, the settlement will be, let us say, in US dollar at this rate, like that. So this type of arrangement made well before the agreement is finalized, so that when a quarterly account is settled, the accounting will be in the respective uh, currencies, but settlement will be as per the arrangement made already. So these types of arrangements are known as currency clause. Next is, we have spoken about the cash clause arrangement also. I have spoken about the setup clause also. These are some of the examples under this. You have net retained lines clause also, which says that this will be protecting only the portion of any insurance or reinsurance which the ceding insurer retains net for his own account. I am protecting only the insurer's retention portion only for his net account, and it cannot get increased due to the inability of the ceding insurer to collect from any other reinsurers. Just because reinsurer B and C have not paid their portion, I will not bear that share also. I will only bear only to the proportion of the net of the insurers. So this is coming under net retained loss. So these are some of the examples which we have seen. There is a downgrade clause also. That means that if during the year, if any participating reinsurers grade is coming, rating is coming down, then if you have this clause, then you can replace the reinsurer with another insurer whose rate is as per the minimum IRDS regulations. So that is coming under downgrade clause. We all know what is the cut-through clause. So cut-through clause will also be there. And then very importantly, I have spoken about the claims control clause. So these are the clauses which are normally given under the proportional treaty. Now we are going to go to the next set of accounting and how the premium is paid. We now know that in the case of surplus treaty, the premium and the claims are either paid or collected as per the quarterly accounting period. And if any big loss is there, instead of waiting for the quarterly accounts to be rendered and confirmed, we can get it immediately provided cash loss facility is there. So at the end of the year, if the treaty is producing profit, you are asking for profit commission apart from the reinsurance commission, which can be either on flat basis or on sliding scale basis. If you go to the non-proportional reinsurance, even though you are paying reinsurance premium for the protection which you are purchasing, you are not getting any commission there. So this is the biggest difference between the proportional and non-proportional. The other point which we need to keep in mind is this. The reinsurance, the excess of loss premium normally is done on normally three different bases. One we call it as payback period. That means how much time it takes to recoup the cap losses, say over a period of 250 years or something like that. And then you have the exposure basis rating, which is an actuarial rating, and then based on the historical rating, which is coming under the burning cost method. So it can be any of these, by any of these methods. It can be payback method, it can be by historical method, or it can be by exposure actuarial method. The premium is arrived at for any excess of loss cover. 300 excess 15, 400 excess 25, 800 excess 100, whatever be the size of the cover, the reinsurance premium for that is arrived at by like this way. Since you are protecting your net, whatever rate that they are giving, that is to be applied on your net premium, which is known as GNPI, gross net premium income. I repeat, the rate, whatever they are giving, is to be applied on GNPI to arrive at the adjustment rate. GNPA is nothing but gross net premium income. Now, when I say that these premium rates, as I told you, can be of three different ways. One is that if you are purchasing a cover, the reinsurer may give a flat rate, say 10% for this cover, or a flat premium, 5 crores for this cover, or by a burning cost method where you will have a minimum and maximum rate to be adjusted after the year-end accounting is over. Now we are going to see one by one as to how it is being done. We have seen all these non-proportional risks, so I will not talk about that. We are only concentrating on the accounting aspect of how it is being done. See, now we will come to the accounting. This example tells you that cover limit is for 50 excess 5. There is a net claim of 60. So that 50, again, reinsurer A and B there. 90% of the loss goes to A and 10% of the loss goes to B. Since the loss is 60 and the cover limit is only 50, 10 goes back to 5 goes back to the reinsurer. This is what we have seen here in payback method and burning cost method. Now we are going to talk about this now. So what is a burning cost method? We are going to understand this so that if there is a sum on this, we should be able to understand and work out. Usually, when you have a rate to be calculated for any excess of loss cover, it is known as flat rate premium. That means I will apply that rate to the respective cover limit and then I will arrive at the premium. Now you please follow me. Just forget about this PowerPoint now. I am talking about one calculation which is done on flat rate basis. Supposing if I have a cover whose cover limit is, let us say, 395 excess 5. The 395 excess 5, I will split into 5 layers. These 5 layers will have different rate of premium. And if I add all the rate of premiums of all the 5, I will get the premium rate for the program. For example, if I have a program for 395 excess 5, let us say for the first layer 20 excess 5 is there, then for that I will have one rate of premium which is, let us say, 2%. This 2% has to be applied on the GNPI, and whatever premium you are getting, that will be the premium for that particular layer. That means I'm going to show you one example of how the loss recovery is being made and how the claims can be adjusted. Let us take this example to understand our working now. The overall cover limit as per this example given here, it is 150 crore in excess of 15 crore. Correct? No? This is a 150 crore cover in excess of 15 crore. This 150 crore is split into various layers like what you are seeing in the screen. First layer is 50 excess 15. Second layer is 40 excess 65. And third layer is 60 excess 105. As we have discussed earlier, if any loss happens, the net loss has to exceed the loss deductible given here. Let us say gross loss is 100 crore after deducting all other losses recoverable from various reinsurers surplus treaty fact. I have 20 crores only. That is my net loss. That 20 crore will be my net loss. But in order to recover from the layer 1, I have to first bear 15 crore. So that means I'm eligible for recovery only for 5 crores. Let us take one more example. There is a risk loss which happened on 7th July. The net loss is 75 crores. One risk loss has happened. The net loss is 75 crore. And I want to recover this net loss from the reinsurers. So what is the layer limit in layer 1 limit? 50 excess 15. So I have to first exhaust 15 crore out of the 75. So how much I have now? 60 crores. But what is the limit of layer 1? Layer 1 limit is only 50 against 60 crores. So I will fully utilize that. So balance left is only 10 crores. Balance left is only 10 crores, which obviously will be recovered from the second layer. In this example of 75 crore net loss, I have already deducted 15 crores, which I am prepared to bear. Balance 60 crores is there, out of which, since the layer 1 limit is only 50 crore, I have fully utilized that layer, recovered it. Balance 10 crore is there, which again will have to be recovered from the second layer. But this example tells us that since you have already recovered fully of 50 crore from layer 1, the layer 1 has been completely utilized and burnt. You have fully utilized this 50 crore against a loss which happened on 7th July. But there can be one more loss also in the near future. If there is one more loss of this nature happening during the currency of the policy, do you have any protection for recovering under layer 1? No, because it is fully utilized. This tells us that in order to have utilization of layer 1 again, you should have the reinstatement facility. Like the engineering policies, excess of loss policies also have this protection of reinstatement facility. If at the time of purchase of this agreement, you buy this reinstatement, then it will be incorporated in the excess of loss cover itself. For example, layer one, they will say 1 at 100 as to amount, 1 at 100 as to amount. What they mean by this? They mean this. For example, in layer one, we have 50 crore. We have fully utilized that 50 crore for a risk loss which happened on 7th July. I want to reinstate this layer. So in order to reinstate this layer back to 50 crore again, I need to know what is the premium to be paid for this layer one, which is available when I was purchasing of this cover by arriving at the rate on GNPA, whatever rate they have given for layer one. If I apply that rate on GNPA, I will get the premium, the cost. So the cost, whatever I have for layer one, which I have already paid, since I have this reinstatement facility, I will pay this proportionately for the amount utilized or fully as the case may be. Supposing if you have only recovered 35 crore, you can reinstate the 35 crore by paying only for the 35 crore, but not on pro rata basis, but on 100% basis when it says 1%, sorry, 1 at 100 as to the amount, 1 at 100 as to the amount. When you have this word 1 at 100 as to the amount, that means you can reinstate for the amount you have utilized, but not on pro rata basis. You have to pay fully. Only as to time when they say you have this arrangement of paying only for the unexpired portion of the policy period or the treaty period, like that of engineering policies, which we normally do. So what we have now learned is that there is a reinstatement facility to take care of such policies of excess of loss cover. The excess of loss cover, which we have seen now, is the arrangement is same for the catastrophe loss also. The only difference between Cat XL and the Risk XL is that there is a two risk warranty, which says that to enable to recover from the catastrophic excess of loss cover, there should be minimum of two risks affected in the event. Let us say for a catastrophic loss, you have a similar cover, what you're seeing in the screen, just to understand, I'm just saying. You have a similar cover for 150 excess 15. Actually, the limit will be very high, so also the deductible. But for understanding easily, I'm taking this same example. If you see this cover is for 150 excess 15, split into 3 layers. Now, let us say it also has a reinstatement facility at 150%. That means when you reinstate, you have to pay 150% of the layer one rate. Now, when I talk about catastrophic excess of loss, I am giving one example. Let us say there is a flood from 1st July to 15th July. And if I accumulate all my net losses, and the net loss is coming to, let us say, 100 crores. If I go to the reinsurers and ask for recovery in excess of my loss deductible, they say that, sir, please go through our clause in the treaty condition. Under page number 42, if you see, there is one hours clause. Have you seen that? The hours clause restricts the event to certain hours. In this case, let us say that this is restricting only for 168 hours. Let us say that for this flood, the restriction is for 168 consecutive hours. That means how much days it is? 5 days. When you have this condition of hours clause, it stipulates what is the maximum consecutive hours that is eligible for claiming under one event. So I said 168. If you divide it by 24, you get 7 days time. So you have taken from 1st to 15th July, for example, and arrived this amount. Now you find out by taking this hours class. If you take 168 hours, that is, I'm just giving you an example, it comes to 7 days against the 15 days. Now you have to take 7 consecutive days. You cannot cherry pick 6th, 9th, and 11th like that. You have to have consecutive 168 hours class. When you take that, then you will find out that instead of 100 crores, it comes to only 50 crores. So that means if you want to claim for another 7 days also, you can claim, but again, there will be one more deductible and you will be utilizing the reinstatement facility for the same flood twice and without leaving any recovery for the subsequent portion of the year. So this tells you that whenever there is any cat loss is there, this hours clause comes into existence and this hours clause is there and this hours clause talks about the limits of hours. So they give you duration and extent of any loss occurrence so defined that has to be applied. So it can be 168 hours, it can be 72 hours, or it can be anything 48 hours, depending upon the hours class condition. This is coming under catastrophe excess of loss. Now, we have seen all these conditions, like proportional treaty in excess of loss also, we have to recover the claim as well as make the payment of premium. So when I want to recover the claim and pay the reinstatement premium, how does it work? Let us see by going through some of the examples now. You see here, this example is on burning cost method, which is on historical basis. So this rate is given on burning cost method. What is burning cost method? It is the method by which the minimum rate that is required for a reinsurer to pay the loss. That is the rate known as burning cost method. How this rate is arrived at? This is arrived at by dividing the GNP by incurred claims. So if you see here in this example, we are now talking about the burning cost. The burning cost is how it is being done. It is given here. If you see, we have the GNPA and we have incurred claim also. So in the exam, they will give you like this, and they will give you the minimum and the maximum rate like what you are seeing here. So here, in this case, you are seeing an incurred claim of 10,50,000 and GNPA of 5 crore. We know now what is GNPA, gross net premium. So when you have a sum like this, they will give you the GNPA, they will give you the incurred claim. You have to arrive at the burning cost. It is nothing but your incurred claim divided by your GNPA. You can see, the incurred claim is 10,50,000 and GNPA is 5 crore. If you do that, incurred claim by GNPA percentage, you will get the burning cost rate, which is 2.1, which is just the minimum required premium for paying the loss. That means it is just a touch and go. So in order to take care of their administration expenses, inflation, etc., the universal practice is to load this burning cost by 100 bar 70 method. So when you load this 2.1 into 100 bar 70, you get 2.1 into 100 bar 70, you get 3. So loaded burning cost or LBC is arrived at by multiplying the burning cost with the factor given in the question. So the question paper itself, they will give you the loaded burning cost factor. In this case, it is 100 bar 70. It can be 100 bar 75 also, that they will give you. And one more thing, if you see just below that, they have given you the minimum rate as well as the maximum rate also. So what that means, if you go by this example, 10,50,000 is incurred loss divided by GNPA into 100 gives you 2.1. That is the minimum required premium to pay the loss. So in order to take care of his administration and inflation expenses, you are multiplying 2.1 into 100 bar 70. The ultimate LBC rate is 3%. This is to be applied on the GNPA and the premium has to be paid. But what is the minimum rate they have given? They have given 4% as the maximum rate, whereas you have a 3% only. Since it is 4 minimum rate, you are applying this 4 on the GNPA. So whatever premium you are getting, that is the Excel premium. And then very importantly, I said, if any deposits are paid, the same to be deducted from 20 lakhs and balance to be paid. This type of working is coming in the exam for scale 3 and 4. What we have seen is how the Excel can be worked out based on the loaded burning cost method, LBC method. In the example as I given here, in the question paper also, they will give you GNPA, the claims, as well as the minimum and maximum rate with the BC and the LBC. So now we know that if they give all these things, you have to work out. So first you will work out the BC rate, and then you will find out what is LBC and whether that LBC is within that minimum and maximum or more, and then you work out accordingly. After that, what they have to do is, in the exam, they may give that the deposit so far paid is 50 lakhs, 10 lakhs, like that. If you see here, there is a premium of how much? More than 20 lakhs. Now, out of 20 lakhs, if any deposit is paid already, if the question says that deposit already paid 5 lakhs, then you will only pay 20 minus 5, 15 lakhs to the reinsurers. So that you have to take care about those deposit premiums. So this is how it is being worked out. And flat rate, flat percentage is not a problem. You are going to apply it directly on the GNPA. Only worry is on the burning cost method, which we have just now seen as to how it has to be worked out. So this is very important as far as the excess of loss reinsurance is concerned. Then I will show you now the balance, whatever we have discussed again. We have spoken about this, we have spoken about this, we have spoken, and this excess of loss reinsurance arrangement we have seen. Stop loss, we know, payback method, burning cost, and loaded burning cost also we don't know. In this example, we have seen how the burning cost method working is done with the minimum and the maximum rate. And then there is a reinstatement calculation also I have provided. If you see here, what does it say? There is a limit is given 50 lakhs, excess 10 lakhs. Then you have GNPA and adjustment rate. Now there is a recovery of 12,50,000 and Excel cost is given. So what is the reinstatement premium to be paid? This is the question. If you see here, there are two reinstatement at 100% AP pro rata. It has to be paid on pro rata. So pro rata to the period, that means for the time. If you see here, this is for pro rata to the period. Here it is pro rata to the amount. There is no period here. You have to pay fully. So in this example, if you see, when they say to reinstatement 100% additional premium, that means whatever layer premium is there, that is to be paid 100%, but you can pay pro rata means if you have utilized only partial of the a portion of the layer limit, that portion of the layer limit can be reinstated, but not for the pro rata time. It has to be paid fully. So if you see the recovery, it is 12,50,000. Excel cost is this much. So for 50 lakhs cover to reinstate the portion which we have utilized. How much we have utilized out of 50 lakhs? 12,50,000. That can be reinstated, which comes to 74,808. But we have not worked out this into days divided by 365. We have to pay fully. In contrast, against this pro rata to the amount, if it is pro rata to the period, if you see down, you are multiplying it by for the unexpired portion, and then you are arriving at the premium. This is as to the period. So this is the difference. We should know that. And we are going to see some of the classes, not all exhaustively. We will see some of the classes. A rate on land. The rate applied to the limit of it cost to the layer. See, we have seen that, if the layer one is fully burnt, it can be reinstated by paying the respective premium either pro rata if you have used only partially or full premium if it is used fully, depending upon the loss you have recovered. To do that, you should know what is the premium for that layer. The premium to the layer is known as rate on line, cost to the layer. It can be cost to the program also. When I say program, it is for the entire cover limit. Next is a common notice of cancellation, which applies both for it applies for the proportional reinsurance also, mainly proportional reinsurance. It saves the trouble of observing the notice period mentioned in the agreement and where he is unsure of his procedures for reviewing the treaty. This is happening when the treaties are on a continuous period, like there is not it is not for 1 year. It will be from 1st April onwards. They will say subject to cancellation. So when you have notice of cancellation, you will have provisional notice of cancellation as well as a definite notice of cancellation. This sudden death clause is there, which is normally happens when a war is happening between the country of residence of the ceding insurer and the country in which the reinsurer resides or carries on business or is incorporated. The agreement will be automatically terminated. So these are all the scenarios under which the sudden death clause or the invoicing can be done. So you have already entered into an agreement, but somehow due to some oversight, there is some correction has to be made. Then if you have this alterations clause, this clause provides for making any amendments with the consent of both the parties. So I need to tell the reinsurer by oversight, I have mentioned this, so this need to be corrected as long as it doesn't make any material change to the agreement. That is very important. Errors and omissions clause, this clause is designed to protect the ceding insurer against any inadvertent delays, errors and omissions. So this provides protection. Set of clause we have seen, accounting clause we have seen, currency clause. Preliminary loss advice is actually supposed to happen prior to cash call. So we have spoken about cash call. So before that, when you have come across such a huge loss, you have to keep the reinsurers informed about this. So this is known as PLA, preliminary loss advice. And follow the fortune is nothing but since the reinsurers are protecting the insurer's interest in their policies insured, so they have to follow fully the same terms and conditions as per the original insurance. Premium to be paid to the reinsurer at the same rate as received by the ceding insurer. That means you should not reduce your agency, deduct your agency commission or any expenses on that. Whatever is collected is to be paid to them proportionately. So we don't know what is ultimate loss, gross loss, plus any recoveries from other reinsurance. Hours loss, we have spoken. PML excess clause. This is actually what is happening is when there is a error in the assessment of PML. If PML is bust, what will happen? How the laws, the reinsurers will respond. If you have this clause, they say that the additional liability to be borne by the reinsurer shall be limited to 50% of the amount that would have resulted had the PML not been paid, exceeded. So he is putting a condition that the liability at the most cannot exceed what would have been paid if it had not exceeded, that is 50% of the amount already paid. This is PML excess clause. Extended expiry clause. So if the cover is ending on 31st March, if there is an event clause which has started on 30th March and it getting extended to 2nd April, then it will be considered that the existing reinsurer is responsible for the same. So that is what it says. It is understood and agreed that subject to the other conditions of the agreement, the reinsurer hereon is responsible as if the entire loss or damage had occurred prior to the expiration of the agreement. Downgrade clause we have seen, cut-throughs have. So index clause is also normally, it is linked to the inflation and this is normally used in our motor excess of loss covers. Claims cooperation clause, we have seen claims control clause, cut-through clause. So these are all some of the clauses. As regards to the reinsurance program, no? Well, we need to know what is a reinsurance program first of all. This reinsurance program is nothing but, to tell you very simply, it says that what are all the retentions you have decided to keep in any portfolio, what are all the subsequent reinsurance arrangement you have made, and the protection arrangement you have made to take care of your net. So in a nutshell, it is like this only. So if you have one sheet for fire portfolio, it will talk about what is the retention limit you have decided to keep, what are all the subsequent reinsurance arrangements, and what is the protection you have made for protecting your net loss. This compilation of all the departments along with your inward acceptance, guidance and limits is known as reinsurance program. This is known as reinsurance program, and we should also know the IRDA's regulations on the RI program. It says that reinsurance program it is proposed that RI program for the forthcoming financial year in the specified summary format has to be submitted at least 45 days before the commencement of the financial year. This is very important actually. Next is they are saying that it is to be filed with authority within 45 days of the commencement of the financial year, and the board approved final RA program specifically highlighting improvements in net retention per insurance segment and also for the preceding year as well as for the proposed reinsurance program should be filed with them within 45 days. Then within 90 days of the commencement of the financial year, a certification from CEO confirming that all treaties associated with the reinsurance program for the financial have been received in original, duly stamped and signed. So there are certain periodicity they have given within which it has to be done. So what I will do, I will share this IRDA's regulations so that it will be easier for you to understand. Very importantly, it also speaks about what are all the priorities, like how it has to be done when reinsurance terms are sought. First, to whom we should ask, who are all the other reinsurers to be contacted. The same way for placement also, they have given certain guidelines. So these are all available in the IRD guidelines. So through online, I will not be able to give you these details. So I will share this. You please go through so that you will be able to understand this. Not a very difficult thing. It tells you what is the time limit and from whom you can get the terms and to whom all you can place the business. Now we have spoken about this. We should also know one important aspect. This is known as inward reinsurance. The inward reinsurance means the insurance companies also nowadays are accepting inward reinsurance. It is there for quite a long time. It can be foreign inward or within Indian inward also. It can be on FAC or treaty or on retro also. The idea behind is to increase the gross premium as well as the net retained premium, as well as to achieve a lower expense ratio, be the maintenance of volume of premium income, because you don't have to open any office sitting at one place in head office itself. You can do provided you have manpower with the technical know-how. To obtain a better and wider spread of business by riding business from overseas and also to counteract the drain of foreign exchange on account of reinsurance seated abroad. That means you will get more foreign exchange when you underwrite business from abroad. To earn an investment income which may be derived from the cash flow resulting from inward acceptance, and also to act as a window on international reinsurance market. So it can be on reciprocal as well as on non-reciprocal basis also. When I say reciprocal, that means you will be in their books and they will be in your treaty books. So this is known as reciprocal arrangement. When the reciprocal arrangement is not there, only it is on one-sided. That means if they want to participate, they will participate, but there is no condition that you should also be in their books. It is coming at non-reciprocal. So these are all some of the methods followed in inward acceptance. We should remember one point as far as inward acceptance is concerned. When you get a proposal from any country on inward acceptance, you will have to be very clear about the political scenario and the relative insurance, internal insurance requirements and all this are there. So we have to be very careful when we are accepting this. You cannot accept a risk from politically unstable countries because you do not know whether you will be receiving the premium. And these are the points to be taken into account when you are doing your inward reinsurance. We are talking about common terms. I said no seeding session. So we have given that what is session, what is seeding company. So we have spoken about all this at length. So I'm just skipping this. See, we all know that you are looking for a reinsurance rating also. It can be AAA, AA, A plus like that. So these are all done by the credit rating agencies only. So this slide is about that only. It's a very simple thing. You have Standard and Poor, you have AM Best, and you have Moody's and Duff and Helms. These are all worldwide. For within India, you have these credit ratings in India, CARE, CRISIL, DCR, and of course ICRA also is there. These are all under this. Now, I want to talk about this alternative risk transfer, which is very important. We all have gone through the reinsurance arrangements and we have seen how proportional reinsurance arrangement is there, non-proportional is there, how it is helpful to us, how we are giving accounting and all. There is one lesson which is on alternative risk transfer. So this tells you that it is a consequence of rethinking the role of insurance in financing loss due to a risk. So it is a mixture of the insurance and the capital market, the share markets. So the intention is to cover a customized combination of event risk and financial risk. That's what they are saying. And they have given some examples like, alternative type of risk carriers, self-insurance, risk retention group, pools and captive. This lesson has some theoretical definitions on points like this, which I would request you to go through because there is definitely a question comes on this alternative risk transfer. Some 6 or 7 pages are there, but I have given you some of the important definitions, which I took it only from the lesson. So these are all theoretical, this one. So you need, but you should know because questions are coming on this, like what is financial reinsurance, like that, futures, options. These are all in the trade business, swaps, derivatives. So these are all there, securitization. So we need to find out. So kindly go through this. I'm not discussing much on this, but I have given you the glimpse of it, whichever is there. I have spoken about IRDA regulations and the placements, how it has to be done, and how this is the minimum rating or their maximum overall how much session is to be allowed as per CBR. All these are given here. So this is about the IRDA regulations. So you please go through this with the regulations, which I will be sharing this to you, which is very important also. So we have roughly gone through the major components of this reinsurance. Main emphasis is on how the proportional, non-proportional reinsurance works and how the accounting recoveries are being made, and what are all the technical terms we have seen and the clauses and the wordings. I would request you to go through the book immediately today so that whatever we have discussed here will be useful to you. You can really easily recollect as to what we have discussed. And if you have at any point of time any clarifications or doubts to be discussed with me, you can speak to me or write to me also. My email ID is Swaminath Anand, SWAMINATHANAND at gmail.com. I repeat, SWAMINATHANAND at gmail.com. My mobile number is 8870941186. So you can write to me. Last year also I had some feedback as to some of the questions which our participants have seen in the model questions, whatever they have received. So if you have any such doubts, you can always write to me or send me through WhatsApp. When I find time, I will immediately go through and respond to you. So at the end of this reinsurance book, you have glossary of terms also. So if you go through that glossary of terms, it is not very technical. It is easy only, self-explanatory. So you please go through that glossary of terms, which will be very useful. Questions may come on that also. So this is how I have tried to squeeze in all the important points, and I will share this slide also to you. So with this, I'm winding it up, and I wish you all success in your exam. Thank you.
Sir, question session will be there, sir. Just
Yeah. You can tell them that we will open for 10 minutes, and whatever is possible, we can immediately sort out.
So what about accounting year method, sir?
See, accounting year method is nothing but whatever policies you are issuing. It can be from last year also, it can be from this year also, it can be from next year also. So the policies for which the overlapping is there, which falls in the current year's treaty, for which if you are underwriting any premium, that will be coming under the accounting year practice. For example, in case of miscellaneous surplus treaty, it can happen like that. So if you get any premium in the next year, which is accounted during the current year's treaty, that will be on the accounting year basis. On the contrary, you now know the underwriting year basis. Underwriting year basis and accounting year basis are not very, you should know that this is being done for calculating the profit commission purpose actually, because whenever there is an overlapping is there at such a scenario, then the premium reserve and loss reserve will be there. That has to be taken care of. So that is why in such cases, this accounting year basis will happen. On the contrary, you have seen how the underwriting year basis works. Underwriting year basis nothing but straight opposite to that. All the premium which you are collecting at a later period will fall onto the current underwriting year.
Sir, is it similar to loss occurring basis?
No. That is different. Actually, loss occurring basis will only happen in the non-proportional rating. In our excess of loss only happen, because in loss occurring, they are very clear. Losses should have happened in this during that period. So losses occurring during basis is in the non-proportional arrangement. Any other points? If you have any other points,
some
also
problems.
you can write to me also. You want some problems to work out, is it?
Yes, sir. Yes, sir.
Okay.
Or differentiating between surplus or facultative or quota share, whatever to differentiate between different types. If we have some problems, it will be easy for us to understand, sir.
I will try to give you one sum on these three. Surplus treaty, I think you have, if you go through my PPT, there you will find out one example under surplus treaty and one example under the excess of loss also. So I will share you some, solutions which will talk about how to calculate for surplus treaty. I mean, what you are asking is how a surplus treaty premium is worked out, isn't it? That is what you wanted to know, isn't it? When you are accounting
Yes,
a
sir. In the
surplus.
aspect of claim, no, in the aspect of claim, sir, if we are insuring under surplus treaty and if it is
No,
like problems on base of
yeah,
claims, sir.
I understand. I understand. See, you have to be very clear on this. When there is a claim on surplus treaty, please note there is no working involved here. Only thing you are going to recover the reinsurer's share from the quarterly account. Only thing is that if a loss is so big, you are not going to wait till the quarterly account. You will be asking for recovery immediately, which is under cash call. So under the surplus treaty, like what I have shown in my example, if you have paid some 100 rupees as premium in the first quarter and 70 rupees to be recovered in the first quarter as claim, you are not working out anything. You are simply giving that 100 as income and 70 as outgo to him. And 100 out of 100, you will get 10 crore as 10% RA commission, which is an outgo. How the claim will be arrived at, supposing if the question is like this, they are giving you one reinsurance arrangement and then they are giving you one loss scenario, then you should be able to apportion it. So that I will give you. You got the point now?
Yes, sir.
Yeah.
Yes, sir.
What I'm saying is that I will give you one example where I will give you the reinsurance arrangement, obligatory surplus treaty, 3 lines. Like this, I will give you, and I will give you the loss amount also, as well as the sum insured. So first, what will you do? First, you will work out the risk apportionment, correct? No? What we did, what we did, we gave away 4% obligatory if it is there. Then we have given retention. Then whatever surplus treaty limit is there, we have worked out. So in the question which I am going to give you, I will give you first what is the 100% risk limit, sum insured. What is the sum insured? What is the reinsurance arrangement we have? 10% obligatory, maximum net this much. Surplus treaty 5 lines. Now you tell me what is the recovery from the surplus treaty. So what will you do now? What will be your first step? First step always will be to underwrite, correct now? Hello?
Yes, sir.
Yeah. So I will share that to you. I'm just telling you as to how to do now itself. When I give this example like this, first what will you do? You will take the sum insured. First you will underwrite it. You will apportion it, find out the percentage, and you will know what is the percentage of participation under surplus treaty. If it is 20%, whatever loss is given, you are going to recover 20% of the loss. Is that clear? So I will give you one example like that on surplus treaty, and one example in excess of loss cover as to how to calculate the reinstatement premium also. Is it clear?
Yes, sir.
Yeah. Any other points?
Excuse me, sir.
Yeah.
When you were explaining about that commission on what is it, profit earned for surplus
Yeah.
treaty, you
Yes.
told that one side we will write their outgo, the other side their income.
Yeah.
In income side, you also included the loss which was taken over 90% of the step.
Yeah.
How come that loss
I will tell
can
you.
be?
I will tell you. I will tell you.
Yes,
I
sir.
hope others are also following this down. She is asking how you brought the loss under the income. If you recollect what I said under the clean cut method, for any given reinsurer's account, there will always be an entry in the first quarter, which is nothing but deducted from the previous reinsurance. So the premium of 35% of the last years and 90% of claims outstanding last years will be credited to the current set of reinsurers. Obviously, it is an income. When they go to the fourth quarter, what I will do? Same cycle. Whatever premium I have paid in these 1, 2, 3, 4 quarters, I will add up, multiply by 35%. I will deduct. That is an outgo for the outgoing reinsurers in the fourth quarter. So also 90% outstanding. So in any given year, during the first quarter, please note the outstanding will be credited and premium will be credited. This is known as portfolio entry. Whereas in the fourth quarter, when these reinsurers are going out, I will deduct how much? 35% from whom? Hello?
Yes, sir.
35%
Outgoing.
35% premium from the outgoing reinsurers.
Outgoing.
And that will be a outgo for them, as well as 90% of the outstanding. That is also an outgo for them. Yes or no?
Yes, sir. Yes, sir.
So this is how it. That is why you are seeing the loss in the first quarter as an income.
Okay.
Any other
Okay.
points? Yeah, no problem.
Sir, if they
Hello.
give like a rate,
Yeah,
hello. Sir, if they
Sir.
give like a rate online, so rate online will be calculated on gross net premium income or layer limit?
very good question. I will answer this very patiently. Please hear, and then I will send one example also in a day or two. You will get it. First,
Yes.
let us assume you have a cover. I am giving you an example. If possible, you write it down. It will be easier for you, which will be easier for you to understand. Let us assume that you have a cover of 395 excess 5. This is a cover limit, overall cover limit. In the exam, they will give you this cover limit and they will say the GNPA for this cover, this company is 400 million. That is 40 crore. GNPA they have given you. They have given you the cover limit also. Then they will give you the rate to be applied on GNPA. This is the flat rate. I told you, no, flat rate. Hello?
Yes, I got it.
Yeah. Assuming that in the question paper, they are giving you the overall rate to be charged is 11%. Then you will have to apply this on what?
GNPA.
Yes, correct. You have to apply this on GNPA. And the premium, whatever you are getting, is the premium for the entire program. The premium for this will be 4.4, 400 million, it's been 40 crore into 11%, you know, so 4.4 crores. For this cover, the premium is 4.4 crores. Is it clear for you now?
Yes, sir.
Now, if I say rate online, the rate online is arrived at by dividing the premium on the cover limit. What is the cover limit here? 395.
Yes.
So when I have the cover limit, I should apply that and what is the premium to the cover limit? That is very important here. So if you do that, you will get a percentage, which is the rate online. If you do that, you will get a percentage that is rate online. 44.4 or 44, let us take in 44 divided by 395. It will give you 11.14. Hello?
Okay, sir.
Yeah, I repeat, we will take one case where we will say that Excel cost is 44 and the cover limit is 395 excess 5. I want to arrive at the rate online. If I want to know the rate online, what I have to do? I have to find cost to the layer or to the program. So what is the cost here? 44 is the cost, correct? No?
Yes, sir.
divided by 395 into 100 you put. You will get 11.14.
Okay.
That 11.14 is the rate on line. The
Acha.
same way, you will have to apply this for the respective layer. That you can do only if they give you the rate of percentage of premium for each layer. So what they will do, no? For the entire program, I gave you the rate as 11, no?
Yes, sir.
This is a sum of all the layers rate of premium. For example, layer 1 can be 20 excess 5, for which the rate will be 2.
Okay.
When I want to arrive at the premium for layer 1, I have to apply the same methodology, apply the rate on the GNPA, 2 on 400, you will get 8.
Okay.
Are you getting?
Yes, sir. When layers have been given here, 20 excess 5 to 2% should be applied on GNPA,
Always,
right, sir?
yeah, when you
Yes.
apply the rate, it should always apply on the GNPA.
Okay.
But when
Okay.
you want to know what is the rate on line, what will you do? The cost of the layer to the layer limit,
Okay.
or cost of the entire program to the program limit. Here, what is the cost as per the entire program? It is, we found that 44, correct?
44
No,
crores. Huh?
44
Yes, sir.
crores. What is the cover limit? 395. So what you did? You divided 44 divided by 395 into 100.
Okay.
So
Got
same
it,
way,
sir.
you have to divide the cost divided by the cover limit.
Okay, sir. Okay, sir.
So I will tell you one more point. As I told you, you can write it down also. In this example, I said 395 excess 5. This is split, let us say, into 5 layers. First layer 20 excess 5. The rate is 2. I have 25 excess 25 layer 2. I will charge 1.5. Then I have 50 excess 50. Third layer, for which the rate will be 2.5. I'm just giving you an example. Fourth layer, 100 excess 100. Again, it is 2.5. Then the last layer, 200 excess 200. It is 2.5. If I add all these rate, you will get this 11%, which is for the program.
Okay. Mm-hmm.
So I will give one example of how this rate on line is worked out also with the other person who asked about one example on surplus treaty loss recovery and the risk retention calculation also.
Yes, sir. Thank you, sir.
Welcome, welcome. So if you have any other doubts, you can always write to us. It's already 1:40. I don't want to trouble you all. You can write to me or you can WhatsApp me also. Depending upon my time availability, I will take it up immediately and come back to you. Thanks a lot,
Excuse me,
everyone.
sir.
All the best.
Sir, one more question, sir.
Yeah.
So you have explained us very well in the last two queries, and it is really make me understand all the concepts. So one
Okay.
query is that it is regarding line of business. There is certain questions that which type of reinsurance is preferable for fire, for burglary, that way. So is there any specific?
See, actually, if you go through the book, they will give you one or two options. Actually, in reinsurance, there is no fixed formula or methodology which is available strictly for one class of business or the other. One thing we should know that there are certain long tail nature, like motor policies or liability policies, where the surplus treaty arrangement may not be possible because of its nature. For aviation, you always have the excess of loss cover as well as on facultative terms only because of the peculiarity of the business. Whereas in the case of fire or engineering, it is always better to have proportional treaties like surplus treaties, what we discussed. It is available there. It can be done on PML basis as well as on sum insured basis. But nowadays we are doing it on PML basis. So if you go through the book, they are again and again talking about these three aspects only. But I want to tell you that there is no fixed yardstick, like, for fire, you will have only like this. For engineering, you will have like this. No, it can be in any combination. You can have surplus TT and fact, you can have quota share and the fact, depending upon the availability. So that should not be a problem, actually.
Okay, sir. Thank you, sir. It was a very enlightening session, sir.
No issue, no issue. But if you come across any such questions which you see, please share that to me with regard to the retention also. I will respond to that.
Thank you, sir.
Welcome, welcome. Thank you.
Sir, in this obligatory session, which you have told, the two areas where this GIC obligatory session is not applicable. One is terrorism, and what was the other one?
Nuclear, Pulma.
Nuclear.
Okay, thank you all and all the best.
Thanks a lot, sir.
Thanks a lot. Thank you.